Hey everyone, this is Logan Hertz with Hazeltine LLC, and today we are super excited to have with us Hutch from bankingtruths.com, one of the guys I learned from a lot in the industry. Hutch, thank you so much for being on the show. How are you doing?
Excellent, Logan. Yeah, thanks for having me.
So, I always want to start with why. You and I think, are in the same business. So, why do you do what you do? How'd you get into it? What's your story?
Sure. I kind of fell into it. Nobody wakes up saying, I want to be in the life insurance business. And you hear that from all the greats. Nobody goes to college and majors in life insurance. Uh, but yeah, it was kind of a multi-step process. So for one, quite frankly, my dad did pass away prematurely, and he was a business owner. He actually did have a personal policy for $1 million, so he wasn't totally unprotected. But a lot of the planning that's associated with it, he didn't have a key man policy on himself with the business. He did actually have a key person, and he didn't have. Usually, a lot of times, life insurance is tied to things that retain, reward key employees so they don't leave. And that key employee did leave shortly after and almost sent the business in a tailspin. My stepmother had to jump in there and get involved, and didn't have proper estate planning in place tied to it. So things were really kind of unraveled, and obviously it's a hectic time. Emotions are high. Really, people. One of the poor things that life insurance does is it really just buys people time to grieve properly. And when life insurance isn't there and or the proper planning, then you have to make these key decisions arguably when your head is not right. Um, so I think that kind of planted some seeds as to the viability. And my mom's always been in health insurance, and she told me I should get involved in this. And I was doing some investing classes and things on my own and kind of exploring different things with like options, stock trading and stuff. And it's funny when you go to work for a life insurance company that it's almost like military recruiting. Like they'll tell you anything you want if you go to work for them. So I was like, can I get a Series 7 and be like a hedge fund manager? They're like, sure, yes, all of that. And that
And
was
it's
actually at
so easy. It's such an easy business. I mean, it's
right.
easy money, right?
And that was at Prudential. And so you know, not not typically one of the companies associated with whole life insurance or infinite banking. But ironically, I don't know, I don't know how old people are who listen to your show, but I remember a commercial when I was young that get a piece of the rock, and like obviously Prudential's logo is the Rock of Gibraltar. So they actually used to be a mutual company in the 90s. And they would actually send people, like when you bought a participating whole life policy, they would send you a little tiny chip of the Rock of Gibraltar, meaning like you
Hmm,
kind of bought into this
hmm.
mutuality. They did demutualize, and so I started work there, and I remember calling. They didn't sell whole life anymore, but I was like, I was learning about how these policies worked and having to service people and calling people, and they would say like, "Hey, I have all this stock. I have this proof stock. What do I do with it?" So when Prudential demutualized, when they went from being a mutual company owned by the whole life policyholders and they went on the stock exchange, all these people got stock, and we were told we weren't allowed to advise them on what to do with it. But it was just interesting. So and then eventually I just wasn't I didn't become a hedge fund manager. They didn't end up letting me get a Series 7. And but then I started to learn about the magic of life insurance and thinking about, people like my dad and how I could help. And I wanted to really help business owners and entrepreneurs. And I was told that Guardian was a place that really specialized into that. So I ended up moving to Guardian. Great time to be in the insurance business. 2008, October 2008.
Perfect timing. Perfect timing.
Yeah, cold calling business owners, and there was a lot of great thinking that came out of Guardian, still comes out of Guardian. Really great culture there. So I learned about infinite banking. I learned about Leap. Leap is known lifetime economic acceleration process. It's now a planning software. I actually do some consulting for them, a software program. And you can do everything from like holistic planning, or you have different modules where you can show the basically the viability of life insurance more so in like retirement planning. They're not huge in infinite banking, but I heard about all these ideas, and then I just started exploring and experimenting and getting policies on myself, and then working with clients. Again, I was cold calling people. Ended up getting adopted by one of their advanced planning teams, and they were savvy with all this stuff. So I got the opportunity to work on some great sophisticated cases, being baptized by fire, if you will. So there you have
So
it.
so you mentioned infinite banking.
Yeah.
So how did you just sort of discover the infinite banking concept? Was it like a light bulb moment, or was it something that you sort of learned about and then over time you started to appreciate?
Yeah, so like I said, I heard about when I moved to Guardian, there was a lot of really great thinking. One of the agents told me about it, and it just sounds so appealing. That you can become your own banker, as the Nelson Nash's original book, The Infinite Banking Concept, Becoming Your Own Banker, says. It just sounds like a great thing. And obviously, when you first hear about it, you hear it's like, oh, you can kind of run all your savings and reserves and your future spending through this insurance policy and pay yourself back interest. These are the things you hear that sound very appealing, not all of which are true. Um, but I heard about it and just started discovering and researching and finding information what I could. It's not like today with the internet and the YouTubes and whatnot, but there was a book by Nelson Nash. There was a book or two possibly by Pam Yellen.
Hmm.
Pam Yellen does Bank on Yourself, another
Hmm.
whatever
Yep.
infinite banking competitor, but she did probably the most marketing at the time, and she was doing things like radio ads, and there were some banner ads and Google ads, but she had this really long ebook that I remember reading. It was on PDF, or one of the gentlemen had downloaded it on PDF, and it was like 100-page ebook, and you got to like took to like page 60 before you actually learn what it was. It is like, what if you could run all your stuff through this and buy all your cars and end up with more money? What if you could this? Yes, yes, I want to do all this. How do I do it? Right? But it was like it was super pitchy. I guess these days they call it clickbaity, but even like in the ebook. So, read stuff like that. Kim Butler had a great book called Live Your Life Insurance. Kim Butler has been around the space for a long time, and her husband Todd was actually one of the engineers on Leap, the software that I mentioned. And he actually runs Truth Concepts. A lot of the software, when you see agents showing things about infinite banking, a lot of times they're using Truth Concept software, and that was
Mhm.
invented by Todd, who's married to Kim Butler. But she had a great book called Live Your Life Insurance. That wasn't specifically about infinite banking, but it did kind of hint at it. So, I was just a student at the time, and I was in the business, but I was actually, like I said, I was learning about it for myself, and then figuring out how best to show this to clients, because everything was very, very cryptic. Like I said, it took 60 pages to like learn what the thing was, which is why I decided to eventually name my company Banking Truths, bankingtruths.com. And be one of the compliments I get is just that I have so much transparent information with a lot of detail if you dig into my content, to actually learn how this stuff works, what it is, what it really does, so to speak. and just uh and just share the truth and let people decide if it's for them or not.
Yeah, yeah. I think explaining an abstract concept is a difficult thing to do, and I think a lot of the content out there um, doesn't do the best job of explaining it because it's not an easy thing to explain. But with that said, that's kind of the segue into my next question, which, what is the infinite banking concept, right? What is it?
Sure. So the infinite banking, if you just the infinite banking concept is actually a trademark, and it's by Nelson Nash's and his family. He's since passed away. Got to talk to him very early in my career because I was interviewing with different people. But infinite banking concept is an actual thing. Like I said, it's a trademark. It's a book that they put out. Even that book, it kind of reads more like a rant and less like an instruction manual. It is quite old at this point, more than a couple decades old. But infinite banking is a strategy. It's a system really of creating assets that will continue to compound for you. And rather than exhaust assets or consume assets for spending that you need to do just to live, or major purchases or investment opportunities, rather than consume assets, It's really allowing those assets to continue compounding on their respective compound curves while borrowing against them. And to a lot of people, borrowing is a four-letter word. There's obviously the Dave Ramseys of the world and everybody else. You can't borrow, you can't use a credit card ever. Um, but the idea is, even if there was no arbitrage, even if there was an arbitrage for those that don't know it, even if you didn't earn at a greater rate than what the loan cost you to carry, like even if all things were equal, just allowing assets to continue to compound and not stunting that compound curve and allowing them to continue to flourish while pausing or stepping back by borrowing to use for other things that you need to do in your life or other investment opportunities, and then using the spoils of those or your income if you're doing it for consumption. When you pay down the loan, pay back the loan, you end up at a higher place in line on that compound curve than if you had exhausted the assets and had to start over. So, in the simplest terms, and I realize it's not quite as how people are trying to brand the infinite banking, pay yourself back the interest, become your own banker. But by doing that, if you did that in volume with the amount of money that passes through our hands as just people that have to live, raise families, run businesses, invest in real estate, if you're able to basically funnel a lot of those cash flows, the ins and outs of that money through this system, you actually end up with more terminal wealth over time, which means you have more money to invest in the future, which means you have one of the things my dad said that I loved was, son, in the land of the free, your money is a measure of your freedom. So by funneling cash flow through the system, it actually allows you to have more optionality in the future, whatever that means, whether it's for consumption, whether it's for legacy, whether it's for future investments, whether it's for expansions of businesses. You create more by funneling money and volume through this system. Does that does
Yeah,
that work for you,
absolutely. No,
Logan?
I mean, compound interest is a wonderful thing, but
Hmm.
the number one thing that it needs is time.
Yeah.
And the problem, as you point out, is that we can put money away, so to speak, but then we're either we're afraid to spend it, right? So we don't touch it, or
Hmm.
we rate it because we have to and we interrupt that compound interest curve. If we're doing infinite banking, we don't have to interrupt that compound interest curve. We can continue using the money by strategically borrowing against, in this example, a whole life insurance policy, right? So our cash continues to earn for us even while we're using it. And yes, there are borrowing costs, sure, but those are costs you're going to have anyway. I think one concept I've learned that people either don't understand or haven't fully internalized all of the consequences of it, but is really powerful once you understand it, is opportunity cost. What is the problem that infinite banking is solving? It's opportunity cost, right? If I make any financial decision, there's always opportunity cost. So if I pay cash for something, I am not avoiding paying interest. I'm still paying interest because I'm foregoing the interest I could have earned on that, unless I'm doing infinite banking, in which case that capital is still earning interest inside my policy, right?
Yeah, sure. Opportunity costs, it's definitely a real thing. There's no question about that. I found when explaining that or trying to model that over the years, it does get confusing, but you did kind of bring it back to something that is very real. I'll tell you who said it best. Just another great of this industry is Don Blanton. He makes money track software, Circle Wealth. He actually came out with a his own software module called Private Reserve Strategy, and I think about 2011. And Don did a great job of just simplifying the story. Private Reserve Strategy, again, being a different version, a different take on infinite banking, but we're all talking about the same thing. But he said it very simply. He said, "You're always paying interest, right?" He said, "Interest is always involved." Like he said, those borrowing costs are always there. And to the listeners, I don't know if all of them agree with you. It's like, I don't want to borrow. But what he said is, you're either paying interest for the use of somebody else's money, or you're passing up interest on your own money if you have to spend it and consume it. And so that's
There are no
actually like,
exceptions. There are no exceptions. Yeah.
yeah. And so like one of our core videos is 6 minutes long. Um, we actually he had a really cool kind of stair step montage We call it the basics of infinite banking. The way that he had it, it just didn't work for me because I like it went under the zero line. But if you go to bankingtruths.com/basics, this 6-minute video just shows you a very visual way that concept that if you're spending money, right, you have to start from zero every time, and then that money can earn interest for you. But if you're not passing up the interest on your own money and you're allowing it to compound using infinite banking and borrowing against it, and obviously for those people listening, you do want to control your borrowing costs. You do have to make sure that the assets that it's growing in, life insurance, it can work with other things. Life insurance should be the core foundation. You can actually create this cool equilibrium and some arbitrage opportunities to where you are paying interest for the use of an insurance company's money or some kind of lender while allowing that to continue to compound. And when you do pay down the loan, people go, I don't want another bill. I don't want to pay down a loan. But here's the deal. Those people, they would be very quick to fill up their savings account. The Dave Ramseyites, it's like they want to create that, fill the emergency fund. So if they have to exhaust from it, they'd be paying money to a savings account anyway. If you refunnel those exact same cash flows through this model, you actually end up at a higher place in line every time, even though you are paying down a loan, so to speak. So it's
Right,
just
right,
reframing the thinking and also
right.
reframing the same cash flows that exist in people's mind where they're on what I call this saving, spending, saving, spending, saving, spending cycle. If you could
Mhm.
just recharacterize those exact same cash flows through the system, we can prove that you actually end up with more terminal wealth, more optionality, more protection from taxes, not to mention all the ancillary benefits. You know, a lot of my clients say, I don't care about the death benefit. But what's weird is when you model the different insurance policies and you show like this one, well, wait, what happened to the death benefit? Wait, I
Right, 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 yeah.
thought you said you don't care.
That death benefit's really important, yeah, and, I like what you said, because another epiphany moment, understanding opportunity costs, understanding all that, is that you always have to repay a loan, even if you pay cash. If you pay cash, you have to repay a loan. To your point, when I pay cash, I've depleted my savings or something, right? I had to spend something. So now if I want to keep living, I've now got to replenish that money that I pulled out. That's the loan repayment, right? So when I take out a policy loan to finance something and then repay that policy loan, it's the same thing. The difference is that money never stopped earning in the interim, right? Whereas when I deplete my savings and go buy something and then I replenish my savings, I wasn't earning on that money in the interim, right?
Yeah, the most common example is usually buying cars, which is kind of a lame. It's always the most common, right? Buying cars, but it's like if you were going to pay cash for every car, you would have to, like to your point, once you buy the car, well, you have to start saving for that next car in 5 years or whatever it is. Well, again, you could do that, or you could just use that money to pay down the loan of the other car while keeping the money working for you, so to speak. Um,
Exactly,
yeah,
exactly. Yeah, that's it's so important because the question is always is as compared to what? As compared to what? I don't want to pay interest. Well, show me a scenario where you're not paying interest. There isn't any, right? It doesn't exist. You're either, to your point, you're either paying interest directly by paying back a lender with interest, or indirectly by giving up, foregoing the interest you could have earned on that money,
yeah,
right? And that leads me a little bit into some of the misconceptions about infinite banking. You know,
sure.
the supposed objections, which are always based on very fundamental misunderstandings or a very superficial understanding of infinite banking, right? And one of the things they always end up doing, whether explicitly or implicitly, is they start comparing it to an investment,
Hmm.
right? So they're looking at a whole life insurance policy. They're not looking at infinite banking, right? There's the sleight of hand they're playing, and I don't think they're intentionally doing it. They just don't understand. They think infinite banking, I guess, it's just a marketing term for whole life insurance. I guess that's what they think. And then they get lost in the mechanics of whole life insurance, and they obsess over return on investment as if that were a relevant metric, right?
But so listen, I think it comes down from just how people are trained to think about it. And it really comes from a place of this. It comes from a place of like all of us have scarce or limited resources as far as what we can put to save and invest. And if you think about the traditional financial paradigm, you know, somewhere
It's
between
not traditional. I just have to interrupt you. It's not traditional. It's
no,
modern, but I know the
sure.
conventional. Yeah.
So if you think about it, like most people are going to have to spend somewhere between 70 to 90% of the money that passes through their hands on just living. And so they're left with somewhere between 10 to 30% that they can now save in this, say a 401k or whatever, but they have this money that they're not spending. They go put the work to save to have it working over here. And so obviously they have to look at the linear metrics of what kind of a rate of return is this a good place for this limited amount of money that I have after my spending to make sure it's working the hardest, because eventually I don't want to work anymore and I'm not going to have inputs and I'm going to need to reverse engineer, reverse flow this money I put over here working for me. And so I need a rate of return to make that work. And I think where infinite banking is different is that what we're doing is we're using strategic and responsible leverage to recoup, to recapture some of that 70 to 90% that would normally not be working for you. It'd be consumed, it'd be working on somebody else's balance sheet, whether it's a corporation or whether it's a government, whatever. The money left your model, it's not coming back. And so we're basically putting some of that money to work through you for you through this system. And so it's not so much that rate of return isn't relevant, but are you asking the wrong question, right?
Right.
And
Right.
so could you get a better rate of return? Like, yeah, could you put in the stock market and may you get a better return? Maybe, maybe
Yeah.
not.
Yeah.
You might get wrecked.
Mhm. Mhm.
And when
Mhm.
you apply leverage to it, it you need to make sure you have protection there, because if you're using leverage and now all of a sudden there's risk of loss, well, that could go horribly wrong for you.
Right. Right.
And
Right.
so that's part of the reason why whole life insurance is the preferred foundation for any infinite banking strategy, is because it's impossible to lose. Like it's
Right.
guaranteed to go up at some amount every year. But I understand why clients get hung up on the rate of return conversation, because every other money choice they've ever made their entire life has to do with this limited amount that they stand to save. They
Right.
need it to perform so they could stop working. And so rate of return is the biggest metric. When you're
Mhm.
using leverage, right? Basically, we just want a positive rate of return, because now we're able to take assets that weren't able to work for you before and get them to work for you through leverage. But since we are applying leverage, we need to take the risk of loss out of play.
Right. Right. And the ability to control, because when you take out a policy loan against whole life insurance, there are no repayment terms. So you have control as well, right? So
You do.
there's no one coming to repossess your house if you can't make a payment on a policy loan. There's no required payments. Um,
100%. Or if we use a rate of return, if you can go open a margin account with the Schwab, with the TD Ameritrade, and Interactive Brokers, a Fidelity, and you can borrow against stocks. But if you get upside down, they're not going to repossess your house. But what they'll do is they'll just go in there and sell your stocks when
mhm,
they're down the most. And so they're going to have to
mhm,
sell more shares to make
mhm,
sure you don't get upside down on the loan. They're never going to
mhm.
let you get upside down on the loan. And that's how people get wrecked.
Absolutely.
And so it's not the case with whole life insurance. And that's the reason, quite frankly, they let you borrow 90 to 95% of your cash value, is because they know the underlying asset that's backing that loan is guaranteed to go up every year by some amount. And at this point in history, it's somewhere between 4 to 5.5%. We're not talking about like a massive number. And I realize a lot of people, that's where they stop and end, because they go, oh, that's not really a sexy number. That doesn't excite me, right? I want the sevens, the eights, the nines, the tens, whatever they're
Yeah.
looking for. But when you consider that you get that number risk free, and when you can control or optimize
Tax
your
free
borrowing
also.
tax free also, and you can control and optimize your borrowing costs against that, as long as you can get a net long-term positive number off of monies or assets that weren't working for you, this is where it creates a whole other profit center, so to speak, in your world.
Exactly. Exactly. I love the way you explained it, because you're right. People are just focused on the amount of money that they can save, right? So the 10 to 30% of their income. All the rest of it's just slipping through their fingers, and they don't realize there's a way you could actually put that money to work for you too. So whatever rate of return we're getting on that 70 to 90% of your income is all gravy because you're not getting anything today,
Yeah.
right? So even
And
if we're just getting
let,
a
let's be careful, Logan, because we do get the people that start to get this concept and they like it and they're like, all right, I just want to put like everything, all 70 to 90%. And so like you have to be careful there too, because when we get into policy optimization, right? It's not just a totally flexible thing like going to buy a mutual fund or whatever. There are minimums and maximums in terms of premium amounts. You can create some flexibility, but there will always be kind of a range. We call it a field goal to where there'll
Mhm,
always be some kind of minimum due. And that minimum does go to work for you. It's not just a set cost. But what we like to do when we look at somebody's model is look at the predictable part of their cash flow, right?
mhm,
Instead of just saying,
mhm,
let's take all 70 or 90, or if we're looking at a business, how much money is funneling through for inventory? How much money is funneling through, for renewing, purchasing certain equipment anyway. Let's take those predictable cash flows, right?
mhm.
And let's funnel those through a policy. And as you continue to get more acclimated to the system, we can continue to layer on, as
Right,
opposed to just
right.
jumping in, like, let's just run everything
Yeah,
through a policy.
right. Well, I like to talk high level conceptual. You're jumping a couple of steps ahead to
Well, I just
the
wanted to be
actual,
careful. I didn't want listeners
yeah,
to think that you just take all 70 to 90% of their discretionary and non-discretionary spending and just funnel it
and
through a
throw it
policy,
all
because
in.
there are
Yeah.
some of our competitors are out there saying that they absolutely should do that. And I want to make sure we exercise a little bit of caution and discretion in this conversation.
Right, and that gets to there's the conceptual and then there's the practical, the implementation. When we get down into the weeds of implementation, of course, there are drawbacks, there are costs, there are things to be considered. And becoming your own banker is a process. It is not something that happens overnight. You don't just flip a switch and all of a sudden you're your own banker. It takes time. And that's really the number one most important element with infinite banking is the passage of time. Because whole life policies age like a fine wine, right? They get better every single year. But in year one, you're kind of just capitalizing. You're really just building capital at that point, right?
Yeah, so that's interesting. I recently came up with because that year one, like you talked about objections, misconceptions, and a lot of times that is a big blockage. The first year costs in any whole life policy, we always say first years are the worst years. We just recently made a video at bankingtruths.com/expensive, just because that's kind of the buzzword, like, oh, isn't it expensive? Where we actually take an example and we quantify those costs and actually talk about the long-term benefits. Not even just all with infinite banking, but there are actually two long-term benefits you actually get for those costs. A little bit of a trick question, but there is some amount of death benefit always over and above the cash value. There has to be for it to be life insurance. And so those costs go towards buying that. I'm not even talking about like the total, like it's $1 million policy. I'm saying as the cash value grows over time, there's always some amount of death benefit over and above that cash value, even if the policy grows with paid up additions.
Hmm.
And when we measure the rate of return of what just taking those early negative years, usually it's the first couple of years, and we just did an IRR calculation of just the missing money, so to speak, right?
Right.
The money that they
Right.
can't use in
Right.
the
Right.
first couple of years. But then we say, but look, there's all this extra money in a vault for your family. And I realize in a vacuum, you wouldn't go prepay for 2 years for this insurance policy, but it's there. It exists because in people's mind, it's just gone. It's down a black hole. It was a waste of money, but it's like, nope, you get that thing. When we measure the rate of return there, it usually works out somewhere between like 6 to 8% for that. Where it's like, again, probably nobody would just go prepay for life insurance 40 years, 50 years down the road, but it is theirs. And then the other benefit is, you mentioned it earlier in this podcast, is the long-term tax savings. Like right now, you can go find savings accounts where you're earning 5%. It's like, oh, well, what do I need any whole life or infinite banking for? Well, first of all, those savings account, you have to do the saving, spending. You have to exhaust it. No bank is going to give you a 4% loan off a 5% savings account. It's just not going to happen. Um, Secondly, though, the 5% you earn from a bank is not going to equal 5%. Why? Because you got a silent partner in that deal. Your family member, Uncle Sam, is going to want their share. And depending on what bracket you're in, what state you live in, that's going to be somewhere between a quarter to half of your profits. So you think you're earning 5%. That's top line. That's the large print. The small print is that 5% savings account. You're probably earning somewhere between 2.5 to 3.5, maybe 4% if you're, a low to moderate income earner in a tax-free state. So the 5 doesn't really equal 5. And so in that video, bankingtruths.com/expensive, we really quantified just taking those first couple years and all the taxes that were avoided that allowed you to have more money along the way to invest in real estate, invest in your business, buffer your other assets in retirement, whatever you wanted to do. And we quantified what those costs equaled in tax savings. And again, that unto itself was another 6 to 9%, which was pretty cool. And so what's interesting is if I ask people, hey, would you prepay the first couple years, 5 or 6,000 for whatever, 60,000 in death benefit, extra death benefit over your cash value down the road? Most people would say no. But if I said, hey, would you prepay 5 or 6,000 to avoid 100 and something $1,000 in taxes? Most people would
Hmm.
say yes.
Hmm. Hmm.
And it doesn't matter that one of my early mentors said this from Guardian. It doesn't matter what benefits you like best about whole life. You get them all. And you do actually
Yeah,
get
yeah.
you do get both of those benefits. And when you stack those together, the combined rate of return for that, or the early missing money, the early hit to liquidity, that by the way, comes back in spades, comes back with friends.
Hmm.
But just quantifying those two benefits for that early cost is like a crazy rate of return. Like combined, it's like 9 to 12%.